Hi, welcome to Main Street Macro. I'm Neela Richardson. Last week, we got a lot of data on the jobs market in March. On Tuesday, we got a read on job openings in the economy. Wednesday brought out ADP's new national employment report and the Pay Insights report. On Thursday, we got fresh data on initial jobless claims, which is an indicator of layoffs in the economy. And the government rounded out the week on Friday with its jobs report. With all this data now fresh and in circulation, to really understand what's going on in the labor market now, I think it's best to go back to economic fundamentals. Now, before all of you econ 101 survivors start groaning about labor and supply demand curves and turn off your computer, just hear me out. Imagine a simple graphic. On the x axis is the quantity of labor, and on the y axis is wages per hour. Labor supply is the number of workers that are willing and able to work, and the number of hours they're willing to work. Not surprisingly, the higher the wage, the more people are willing to work. Labor demand takes the same analysis from the firm's perspective. The higher the wage, the less labor they demand. And the lower the wage, the more people they want to come work for them because costs are lower. Now, if you add up all the workers and all the firms in the economy, you get aggregate demand and aggregate supply. The intersection of these two lines is the equilibrium or market wage. And for a long time before the pandemic, this equilibrium, the supply of workers and the demand for workers were basically in balance. Wage growth was a little below 3%, and that was right in line with the current state of economic growth and inflation at the time. After the pandemic, we saw a big disruption in labor supply and labor demand. It led to labor shortages. And in fact, wage growth more than doubled over the last year. We also saw high levels of turnover and a struggle for firms to find qualified talent. As ADP reported last week, it looks now that these curves, labor demand and labor supply, are coming back into balance. And for the first time in over a year, uh, equilibrium wage growth is actually starting to moderate down below 7%. So, what all of this means is that for an economy to grow in a sustainable way, which is a way that doesn't peak up inflation, we have to have a balanced labor market. And fortunately, we're starting to see that now. Thanks for watching the Main Street Macro. Thanks for hanging with me as I talk through labor and demand supply curves. For more information and a deep dive into the freshest labor market data we have, go to adpri.org.